All right, so today we had a 1% gain. It's been so rare lately, but we actually got a pretty decent move. The question is, did we break out? We got above some highs. It looks like we might be approaching, maybe breaking through resistance, maybe poking our finger through a little bit. The question is, have we broken through? Like, do we have we established bullish trends on these different indicators that we look at in our process? So I'm going to break that down today. We're going to take a look at when we've been near this level before and what some of these breadth and volume indicators have looked like to see how much juice we have behind this rally, even today, as bullish as we were today. We'll take a look at that. We'll look at what's driving the moves today, and from a sector standpoint, some very interesting moves from a sector standpoint, as well as different asset classes. With yields, especially being a big driver, the dollar is making an interesting move that will, I think, impact risk appetite going forward, and we'll see how likely we are to really extend away, get up above and extend away from these levels that we are breaking above on the Nasdaq, and we'll see if they start to broaden out to some of the other indexes too. And again, as always, I mentioned our goal is to get to 10,000 subscribers on YouTube. So if you haven't subscribed to us there yet, click that subscribe button and let's go ahead and get started. Today is Wednesday, May the 17th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing with this thumbs up icon. Click on that. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. On Twitter, we have the goal of hitting 100 likes. We got the 74 on the last one. So the more it really helps us out. That's why we always ask for it every day. So thank you to those of you who like this day in and day out. Those who don't, you can do right now with one or two really easy clicks while you're watching. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see one of the better moves that we've had in a while, at least to the upside. I mean, we've had some good moves here. Notably, the end of those 2 weeks, that was a Thursday, Friday, that was a Friday. Coming off of bull tags, I mean, one actual bull tag, we didn't quite get, we didn't have the light pink shading there. We were at the 81st percentile. Here, we didn't have the yellow line because the moving average was falling. It was red. So not quite a bull tag, but kind of the same thing. So every time we've gotten this pattern, we've jumped up. Boom, boom, and now boom here. The momentum line bouncing from extreme lows. It's hit extreme lows 4 times. 1, 2, 3, 4, and 3 of those 4 times brought, or 2 of those, the first 2 times brought the near-term line down too. The second 2 times did not. The near-term line rallying here, of course, did not get very far up. So it's it's still just one day. The intermediate line is still in bullish territory, and it's actually rising again, and market sentiment's rising too. They're kind of sitting right on top of each other right now. And then again, we're almost 1% above. Again, one of the better moves that we've had here since that Friday a couple weeks ago. So a good move higher on the S&P. Of course, some of the other indexes look a little bit better. One thing to keep in mind here, let me bring up the drawings, the Fibonacci lines. So this 4150 area is a really important level for the S&P 500 because, again, you've got 2 narrative changes since we had this intermediate decline that we've been retracing for 7 months now without really producing a new one, at least a new impulse move. Right? These are all bullish intermediate rallies, but they're all inside of the retracement zone between 78 and 23% retracements. So we did try on this second one with the exhaustion gap on February 2nd. We did try to get above those 2 lines. Again, the 2 lines are the 78% retracement and the 50% retracement of the entire correction, which notably, getting above changes things up. So you have the February 2nd peak and one more time there right after, And then here recently in May, we've had a few attempts to get above those lines before failing. So here we are again. This would probably be our weakest level. As you can see, the intermediate line over here was in the reversal, was actually at the 90th percentile there. It was still at the 90th percentile there, 89.6. On this close, where you kind of got above it, you were in the 90th percentile. Over here, you weren't in the 90th, but you're above 80 percentile there. So we had a good move going on that one, and then finally, you can see the this last attempt to get above these lines, nowhere even close to being above or at least getting into the upper, getting above in the upper reversal zone. So a little weaker here, not surprising considering how flat we've been and how much we've been converging. So again, one day breaking out doesn't obviously change the trend. We need to see more of that. The NASDAQ, remember, has been breaking through. In fact, it's near its 52-week highs. Oops, sorry, not that one. I wanted to show the drawings, the Fibonacci lines. So it's way up above some equivalent levels. Of course, a 50% retracement's right there of the entire correction. So we're sitting right at that right now. The 78% retracement of this correction off of the mid-August peak, again, that we've been semi-retracing, right? We got it below the 23% line there at the end of the year. The S&P obviously did not. And we have been above the 78% since the beginning of May, end of April, where we bounced off that bull tag and we rallied higher with this cluster, kind of continuing really this move that started in middle of March, so a 2-month intermediate rally that we've been on here. So we're sitting right up against, so that we've already broke the 78, we're right up against the 50, and that's where we got to similar levels here in the August peak. And again, the highest level is 13,720, and we're at 13,590 essentially. Intermediate line, obviously still in the 90th percentile. The near-term line still producing lower peaks as of right now, despite the fact that we've been rising on the actual NASDAQ this entire time. The second peak produced the cluster, and this one obviously no cluster, despite that was actually pretty darn bullish there. Now let's look at the Dow Jones Industrial Average, because it's been index has been really bearish, especially with the Home Depot, which is the 5th biggest weighting in the Dow Jones. You can see the big rally we had today. Momentum line pretty much swung from extreme lows up to pretty close to extreme highs just in one day, despite a near-term line or intermediate line that's still falling inside bearish territory. So you got the dark pink shading. You have a yellow line because we moved up so much, it actually pushed the 30-day moving average higher. We're still below it, so it's yellow, but it's actually moving up there. So that's that's positive. It's still not bullish yet, but it's positive. Looking at the Russell 2000, we actually did finally get above the moving average, so it's green because moving average is rising. The intermediate line, though, and the near-term line are both in neutral territory. Market sentiments is near the lower reversal zone, they're rising. So again, I mean, it's great. It's not really trend changing. It's not a bear tag. Like, we didn't get a bear tag because we're not light green shading and a yellow line. It's already turning higher, but it's the same idea as a bear tag. So we can take off if we can follow through with it over the next day or two, or we can just bounce right back down if we don't follow through, which was the case the last time we got that series of bear tags. Let's take a look at the weekly chart on right here on the S&P 500. It's been progressively getting more these transition candles. You'll notice that the size of the candle, which is what the green line measures down here, the body at least, the Hakinyashu body, is actually kind of flirting with its 3-week moving average. So we might be starting to move, though. It's still really, really small, very convergent. We have a golden cross, but we're not going anywhere, and you can see how we're stuck up against that 50% retracement. The NASDAQ, on the other hand, is strongly bullish. Easily higher high, higher closes, rising PPO, The size of the body is above the average. I mean, very, very good from that perspective. Of course, your Dow Jones Industrial Average, which has been on the weaker side, is actually already flipped to the downside with bearish candle. We don't have a we don't have an upper shadow yet, so we're still in bearish mode here. Lower close, lower low, red arrow on the 10-week moving average, and the size of the candle you can see here is below its moving average to the downside. PPO is falling. So you see a big difference between the Dow and the NASDAQ right now. Let's take a look at the 3 green arrow chart, and this is kind of interesting because we got 3 green arrows in the S&P as well as the Russell. Finally got 3 green arrows there. The NASDAQ's had 3 green arrows now for about a week and a half. The Dow, unfortunately, still doesn't even have 1 green arrow. It actually still has 3 red arrows. So big change when it was the Russell that was so divergent with everybody else, and everybody was green shading. The Russell was just not green and then kind of flirting back and forth. Now it's the Russell. It's got 3 green arrows along with the S&P, and it's the diamonds that's still bearish. So we'll see if these 3 green arrows last for more than just a day, right? Obviously, it couldn't do more than a day before on the Russell, and we've been kind of fluctuating between pink and no shading on the S&P over the last little bit. Take a look at the 3. If I break them out into their own 2-line versions, you can see that nice little breakout here above those Fibonacci levels. It would also be a breakout above the value area of the 1-year chart. So that's a good sign, right? I mean, there's no resistance up here. You got 70% of all the volume in the past 52 weeks is below current levels, including the point of control, the price with the most volume. So I mean, that's a good sign for the S&P as we're trying to break out of the stochastics into bullish territory, kind of get out of this neutral zone that we've been in for quite a while here. Same thing with the MACD. Try to get it going. As you can see, its histogram here is really small. It's like you have to zoom really in to get kind of any significance, and it's still really, really small. So there's no momentum at all going on. As great as the breakout move, it still is not producing momentum yet. Follow through with it with another day like this? Great, right? Now we have the momentum at that point. But today, in and of itself, did not do that. It didn't bring, I mean, we are above 25 on the positive indicator here. We are not, we are below 20. We're not above 30 yet to really get the ADX moving high enough to eventually get above 20 and really get a trend going on here. Of course, your diamonds is a different story. Now it's not as bearish as it was, but it's still relatively bearish there. And then your Qs, we are almost above 30, and you are, like, we have such a discrepancy here. The ADX now is rising above 20, so you have a pretty decent trend going here on the QQQ. Let's take a look at the RSI and the CCI, and you can see we're still very much here in neutral territory. We're not above, we are above 0, we are above 50, so at least we're bullish, but we're not above 60, we're not above 150 yet to really solidify that. So again, not bullish enough to start a trend, just bullish enough to not obviously be bearish. Your whole moving average, interestingly enough, has now flipped the parabolic SAR down. So we have a pretty decently bullish candle, though it has a lower shadow. You are above the 20-day hull. You're still above the 200-day hull. The MACD has moved above its moving average, but not a big candle yet. It's got to be above these blue or below that blue line to really signify that, the increased opportunity for a trend. It is good that we fit the parabolic SAR down, but again, this candle by itself doesn't signify that that we're really bullish or not. In fact, it can, breaking above this orange line, I mean, that's a good sign too. Remember, we broke up and down below it over here, and as well as over here. So we need to get above it, especially get up into this upper quintile would be great. That would help solidify the bullishness that we're just not getting. One thing that we're also missing, of course, is the positive McClellan oscillator. It's still negative, so we're still below 0 on the summation index. And then you look at the money flow, and the money flow is just pathetic. The money flow here, again, we are at levels pretty close to where we were over here on April 28th, just a few, 70 cents off. But if you look at where the money flow is, it's not close, right? We should be pretty much near that level or higher, and the index down at the bottom is trying to get above 50, but didn't today. So, the new highs and new lows didn't get above zero. Got above the moving average, but didn't get above zero. The number of stocks above their 50-day moving average did not get above 250, much less 300 or its moving average. And the 200 number of stocks above their 200-day moving average, even worse, right? We're easily below the moving average as well as below 250. And remember, 300 is the 60% level. So there's still no breadth. There's no volume from a money flow standpoint. McClellan oscillator is still pretty negative. It's still not positive enough. So as great as today looks, and you can see on the Bollinger Bands, we're still got the red dots over here because the bands are still inside. Now we are in the upper quartile, but we're not high enough in the upper quartile, especially not above 100, to really break out and start pushing those bands out, right? So they can push outside of the Keltner channel, and then we can trade outside the Keltner channel, really trend. Obviously that hasn't happened. So again, at least we're leaning in the right direction. But if we think today by in and of itself was bullish enough to start a new trend, it's again just noise. Now it is leaning towards a breakout, right? At least the noise produced a breakout of that sideways. I mean, that was so sideways. At least we did get above last week's high point. We didn't really extend away from it. We kind of flirted with it, but we are well above yesterday's high. We're still above last week's high. We haven't produced a new 4-week high, and both these lines are really dropping pretty quickly. The red line, they're both about to be below 50, which is not very common to have them both below 50, and it usually leads to a breakout eventually. You can see, like over here, they both got below 50, and it led to the green line breaking out. So, we'll see if that ends up being the case again, if we end up getting in a new high point here above. We're not that far away, because the range is really, really small. So we are due a breakout, and again, the odds are the breakout would be to the upside, and breaking above this 4,200's got a lot of technical implications in terms of how strong the resistance is. People talk about, again, are we likely to hit, 4,400 or 4,000? It's like, if we break above 4,200, if we hit 4,400, we're not hitting 4,000 anytime soon. We're not breaking back down. Like we're going to trend higher to the upside. So that's why this 4,200 is so important. There's a multitude of technical factors here that would really trigger if we were to break above it, and it's partly the reason why we can't get through it to the upside. Let's take a look at today's volume and trading range. You saw the trading range was actually pretty decent, like 5 points. You have to include the gap. We closed at 410.25. We had about a 40-cent range to the low. So add on 40 cents, you're over a point more than the ATR. The volume was above average. So we actually did get 87 million right there. We had 87 million, and we had 5.5 points. So those are both pretty decent numbers. They're not so extreme. The ATR relative to the price is so close to 1%. Like, we are so low. The VIX is so low. There is this no volatility here, yet we are still below this 50% correlation mark between the VIX and the VVIX, which again is, and again we're below 85%. We are, so we're bullish, but we're not. Get below 80% now, we're extremely bullish on volatility, or on bearish, on volatility, bullish on risk appetite. So volatility is really, really low. It continues to be really low. It's been trading below 20 now for an extended period of time that we haven't seen for a while. You notice it's been a while since we've had an extended move below 20 on the VIX, right? We had a few attempts, and over here at the beginning of the year we were below 20, and you can see we were below 20 for the whole time until that Thanksgiving move, and then it was just been brief periods. So this has been a good sign. It's also been a sign, we've been below 90% for a while, and that's a good sign. Volatility is down, but remember, volatility continues to be really low too when you look at it relative to its average values. as we are way down here. The 8 and 17 day are still, we've been converging there, so we haven't been dropping anymore, which is, again, kind of hard to do. But we are still way below the 200-day moving average and below the 10th percentile. And you can see how the stochastics is also still pretty darn low, and coming off an extreme low before we started to get some more of these regional banking news that had a brief increase in volatility up to its 50-day average. So way down, still way down below these averages, still susceptible to fill in these gaps that we have there, especially considering, again, the correlations between the VVIX and the VIX that are kind of poised that are signaling a potential move higher in volatility. Of course, considering the S&P is at resistance, that would suggest that resistance is, as it has been doing, is more likely to hold than it is to break, especially when we don't have the volume or the breadth to break. Barring again, you get a debt ceiling announcement, and we don't get a buy the rumor, sell the news, because a lot of people may be buying, getting up to resistance in anticipation of that debt ceiling coming through, because we're just right on the cusp there. So it might be one of those buy the rumor, sell the news. We're also coming out of earnings season. That's something I tweeted out here from Bespoke Investments. About the trend of the S&P between the time that J.P. Morgan announces and Walmart announces. So the extent of the extent of the earnings season, so to speak. They've been pretty bullish here over the past year. The last 4 quarterly cycles, bearish before that. But this one hasn't been bullish. In fact, we're up against resistance. We got to resistance the earnings cycle before. We peaked with the mega cap earnings on that February 2nd exhaustion gap. But you notice that every time after these earnings announcement ends, even going all the way back over here, we go lower. We go lower. We go lower. We go lower. So eventually we turn back up right before earnings season starts. But we tend to go down. And considering we're at resistance, with very weak breadth, way weaker breadth than we had in any of these other periods, it appears more likely, and lacking the money flow as well, it appears likely, again, a higher probability that resistance is going to hold, despite the fact that we've been sitting around here for so long. All right, now let's take a look at what's driving this price action. So let's go to just today's chart. You can see the Qs and gold have been your big winners over the past 3 months. Whereas small cap stocks and real estate have been your biggest losers. That continues, it's been a common theme for most of this past this rolling 3-month periods. Not the case today. IWM blew the doors open today. 2.25% move to the upside. And that's probably one of the bigger moves. Let's see here. Let's pull this chart up. Let's go to the daily percent changes here. And you can see it. Well, we did have a 2.37% gain just earlier this month, but that included a big gap to the upside that we continue to push higher. So it is the second 2% gain that we've had over the past month or so. We've had one that was the same on that same day. We did have a 2% gain on the Qs, barely more than 1% this go around, and then on that same day on May 5th. We almost had 2%, 1.85, and again, barely more than 1% this one. We were close. We were 1.99 there on April 27th. So it is one of your bigger moves that we've seen in IWM for a good period of time. Real estate, also one of your bigger, weaker moves. Gold underperformed with the strength in the dollar, but the Qs didn't. The Qs didn't follow gold down. It actually stayed higher along with commodities. So pretty risk-on day, especially in the U.S., right? International equities not doing so well. High yield was outpacing treasuries and doing better. Treasuries were down quite a bit, which means we had an increase in yield. So let's take a look at some of those different asset classes and see what their charts are looking like. So the dollar, you can see now, still filling in the gap between the 50 and the 200-day moving averages. Now is above its point of control. Obviously, filling in that gap, there's still a lot of volume here before. Now, if it gets above the 200-day, now we've got something, right? And when you look at the weekly version of this, last week was our first week in a while that we closed above the 17 week. In fact, we closed above the 8 and the 17 at the same time, and you can see the 30 week is sitting here. And the MACD and stochastics both are just turning positive. So we might just be starting a new move to the upside on the dollar. Bonds, on the other hand, you can see are actually rolling back down. So we're crossing below the 30-week moving average as of right now. Week's not over with, of course, but we are, again, well below these daily moving averages that are all starting to spread out, right? We're starting to diverge, getting a divergent move going on with the MACD below its moving average, and we're below the 17-day. That's kind of coinciding with a renewed move higher in yields, now up to 3.58%, trying to get back above its 200-day moving average and back above this 3.6. A move higher in yields is, again, kind of a catch-22. Staying around 3.5% is great for the markets. Moving higher, of course, increases the odds, as we've seen today, of more rate hikes. In fact, you can see the odds of a rate hike at the June meeting has gone up now to 28% from 0% just a week ago. So now this is not very high. It's still low probability, but it has been high. In fact, it has been all the way up to 99% probability before the financial issues started to hit those regional banks. It was above 60% for a good month. About a few weeks before, almost about 3 weeks there, it's been about a week above the 80% mark. So it's, it has been high probability. It has been up there, and probably would be one of our first lines that has been above 60% for more than just a little brief period, to not eventually get up to 100, right? So this would be the 5.25%, and so now, again, this would be the first one that would not eventually get to 100%. That spent a good amount of time above 60%, and pretty decent above 80%, about a week or so though. And you can see the odds of being at 5.5% or even less, though they were also easily above 60 and 80% during that same time frame. You can see 5.75% only was barely above 80% for a day and barely above 60% for a small amount. So much different story. So, it was, 5.5% was pretty much baked in the cake until the financial issues started. Now the financial issues are abating. You think that there's a good chance that we will get up to, that 5.5% mark. That's why you see those numbers starting to increase. Though it drops back down, you still have, your odds of being at 5.25% in September. So your 5% move here, your odds of being at 5.25%, have been right around this area, and you can see if I go back over here just a week ago, the odds of a rate cut, a week ago, the odds of a rate hike were at 80, or cut, excuse me, by September at 80%, just a little bit above 80%. Now they're down to 45, so we're back below 50%. So the odds of rate cuts are starting to drop, even if, again, by December, it's still a 96% chance, so still very high probability. But now only an 80% or 75% chance of a second rate cut by the end of the year. So you can see the odds are declining for rate cuts, and that's actually a good sign for the markets if that continues to be the case. What we don't want to see is more rate hikes, right? But it's because, again, that means inflation expectations are ramping up again. But the odds of rate cuts are declining, and that's a good sign because, again, the only way we get rate cuts is if we take the FOMC at their word, is if they have to, right? If we are really breaking down hard. As long as we don't break down hard, no rate cuts. So that's why I say if we can stay around 3.5%, maybe plus or minus a little bit, that would be the ideal scenario. We're not really bullish. We're not really bearish on yields. We're just going sideways, and we're just kind of hanging in there. We start to ramp up, that means inflation expectations are ramping up. We start to break down, that means economic growth expectations. And those are both bearish scenarios right now for the markets. We don't really want either one of those to occur because rate hikes and rate cuts, and we don't want that. We just want to stay maybe at 5.5%, but 5.25%, and stay that way for a while. And you can see we've been flat on yields since we dropped down here at the end of last year. In December, we dropped back down to this 3.5%, and we've been plus or minus, in February on that exhaustion gap, or on the March lows, and the stock market hit their lows. We had ramped all the way up to 4%. There, the exhaustion gap was actually over here when we were down. There was the exhaustion gap. We got below 3.4%. So as long as we stay at 3.5%, we're good. It's once we start to move up or move down is when we're not so good. Let's take a look at the sectors. We'll do the comparison chart first. You can see the 3-month time frame there, but let's just look at today first. So we'll go to May 17th. And you'll notice that, again, the cyclical stocks really took hold, especially your energy, financials. Those have been relatively beaten up since the market, right, since we really started to get bearish in March. Industrials joined the party. Discretionary is up there with technology and communication services kind of matching the markets. Of course, your safety trades down here at the bottom. Healthcare, staples, utilities. So more days like this, the better, right? That's really what we need to see. One day is not, clearly, as according to the indicators, not enough. And you can, if we look at the 12 grid, remember the 12 grid was so different across the 3 different rows, right? We had strong moves up here with dark green shading and green lines. Those continue to be the case. 3-month highs on XLY, way 3-month highs on XLK, 10% gains. Flat gain there, 9.5% gains, 3-month highs in XLC. You can see energy, those, as much as it was up today, look how bearish it is. Materials, financials, industrials are kind of light green shading. So you can see like not all is great. In fact, you got a lot of dark pink shading and red lines all across the board here. And at best you have kind of neutral in some of these other areas. So we're still kind of riding the QQQ wave, and we had a great day today, but only because we were so oversold. So we need to get these indicators here into light green shading, at least kind of like these two, and yellow line. Then we can start to feel a lot better about this being a broad-based rally, breaking through resistance and everything moves up, versus a very narrow rally to get us to resistance, but not enough juice to push through it. All right, let's take a look at our trade idea of the day. I want to take a look at electronic arts. You can see electronic arts had a really good move higher here, kind of going into earnings, really breaking out after breaking down, coming back up, and then filling in that gap all the way up to where it was pre-earnings, and then has really started to settle down. So a big, strong momentum move. Bearish move back down to the moving averages, and now settling into a very strong zone of a lot of volume here. When you take a look at its moving average, or market forecast, excuse me, you see that we're so dark green shading green line, but now we've really, like all these bull tags, we did not bounce off of them, and the intermediate line's broken down below its market sentiment, moving towards bearish territory, hasn't dropped below 50 yet. But you can see how we're really starting to neutral out. We're not really breaking down below that moving average either. We're starting to neutralize that bullish move. You can see we've got we don't have 3 red arrows, excuse me. But you can see how we're not dark green, and we're just kind of fluctuating. So very neutral level from that perspective. When you look at some of these other oscillators like the DMI, which was so bullish, now both lines are below 20. So it's a neutral level there. The RSI and the CCI are very, very neutral as well. I mean, the RSI is smack dab in the middle of its indicator. The Ichimoku cloud, you can see we're above the cloud, but we're below both the green and the blue lines. We've gone from a positive rate of change to a small negative. No trend, even though it's not really down to 0 either, but no trend going. And then finally looking at the Bollinger Bands with the Keltner channels, we have been in this neutral zone that we've gotten red dots, and whatever bearish momentum we had is starting to wane a little bit there, but still not, I mean, we're still right around the midpoint of the 4-week range. So we don't really have a lot of movement to go, which I really like. That sets us up for an iron condor spread especially with the earnings being past the earnings. I can go into June expiration, sell the low 20 deltas, and then buy or strike away for the protection. You can see we did a full position size here, getting about $375 reward. That's ideally what I'd like to keep my risk to if we start to really break out. You can see the break evens here are at levels that we'd really need to break out to get to. So I like this move and the kind of move. I mean, if it did break out to the upside there, we'd be looking at a strong directional trending move to the upside. If it breaks down here, we'd probably be looking for a bearish directional move before it got to that break even to kind of supplement this. So, you know, I like how neutral it is, as well as the opportunities for a directional trade if we start to see more movement in the stock one way or the other. The upside, we got a lot of resistance. The downside, you don't have as much support. There's a big gap in volume here. So that's really our biggest dangers to the downside. But like I said, we got $375 worth of risk that we can take, because that's what our gain is, in addition to the opportunity to add a bearish directional trade to this if we started to break down. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.